In this lesson, we're going to look at an important concept in trading, that there are trending markets and range-bound markets. I'll begin with the DAX, which is what I've been trading at the moment, and which is what we've been looking at. If we zoom back, so each one of these bars is now a month instead of 15 minutes. So, it's a far more long-term picture. Then we can see it's trending. The market seems to be, on average, increasing. And if we zoom back, so this is, 2011 to 2016. So obviously this is July 2015, so it's only filled up. We only have data points up to then. But we can zoom back. So this is 1980 to 2016. And we can see that essentially, the market has been increasing with occasional collapses. So I'll zoom in a bit here. Okay. So I've commented on this already, but the idea here is you see the market's just been increasing. This is the .com bubble. So then the market crashed. Loads of money had been invested in projects, in companies which made no sense. So they were never going to make money. They'd spent the money, so collapse. Then the markets built themselves back up again till about 2007-8. That was the housing bubble. The 0% mortgages and all that kind of stuff. So then that crashed. Boom. And we've been recovering since. Now, it has broken to a new high, so the trend is still increasing. Since one of the ways that we talk about uptrends is if you get higher highs and higher lows, then you're in an uptrend. So here, well, it wasn't clear. I mean, we basically reached the same high as the previous one, but when we fell, we didn't fall as much. So at least we had the higher highs. Now, or the higher lows, since that low is higher than the previous low. Here we actually have a higher high. Does that mean we're going to get a higher low? Time will tell. Now, one thing to mention here is that recently we've just had the euro devalue from $1, say 47, to $1.08 or 9. So there's been a 30% devaluation in this recent period. So then we'd expect the stock market to basically increase by 30%, or something along those lines. So we have to keep that in mind. Now, another thing to point out. So I have the RSI and I have the plot, and I've mentioned a couple of times, so I just want to spell it out a bit more, be more clear about it. So this concept of negative divergence. So there we look at the actual price action, which is in this chart, and we see, okay, it was here, it fell, it went up, but it didn't really, it barely went higher than before. I'm saying it barely went higher because this one didn't really close that high. It was at one stage up to here, but you know, it's just the wick of a candle as opposed to closing that high. But essentially it's the same level. Now, if we look at the same period at the RSI, we see the RSI was 76, but this time it actually went to 85. So here, the RSI, the market was more excited during this bubble than it was here. If we look at previous history, we see it was very excited in 1997. So we'd have to go back to see historically what the big deal was here. I actually can't remember. I suppose I was in college. I wasn't really following the markets then. So it was very excited here. In the next burst, you know, so this is the next high, the RSI is lower. So that's, we'd call that a negative divergence, where the price action is telling us a different story compared with the RSI. So normally when you see that, you're getting concerned that perhaps this bubble is coming to an end. So by the time we were here, when you know we were at this .com record high, you know, record high at the time, the RSI didn't really respond anywhere near the previous peaks. So that would be a signal to sell, that this, it's better get out. So what about here? Well, here we had, again, you know, we had a peak. The next peak, the RSI is actually higher, so it doesn't look that bad. At the next peak over here though, the RSI is not keeping up with the price action at all. So I'll zoom in a bit more here. So when we were up at the beginning, say at 2007, the RSI was very excited and the price was up. But this time, you know, by the end of 2008, or by the start of 2008, the price is back to the same levels, but the market is, the RSI is not agreeing. It's kind of going, okay, but yeah, it's that would be a sign that, using the negative divergence picture, which again, it's not 100% accurate, but you know, be one of the things you'd want to keep in mind. So the RSI is telling us here, sell. So now, having heard of this, you know, negative divergence, what about now? Well, here we had a peak and the RSI was just below 70. Not all that excited, but bullish. Then it fell, didn't go down that much. Now when it shot up here, the RSI wasn't crazy high, but you know, this isn't a clear peak either. So what about this peak? Well, this is a new high. You know, it is an all-time high, and the RSI is quite high as well. So it's not that clear. But unfortunately it's not that clear, and this is the most important part, because this is what we'd like to know what's going to happen. If we had a signal that there was a negative divergence, then we might sell. We might have a clear sell signal, and selling you make lots of money. Well, the same as going up, but often it falls faster. So that's just introducing the phrase negative divergence, and looking at this chart from a negative divergence perspective. The main point I wanted to talk about here was the different types of market. So this I would call a trending market, because in general the stock market seems to be going up. It goes up, you get a new high, it falls, get a low, you get a new high, you get a higher low. This is undefined. I'd basically say it's the same as the previous high, so it's not a clear trending market in that sense. But when it falls, it's higher, so then I would say, no, that does seem to be going up. And broadly speaking, if I draw a line from the start to now, that's a line going up. There's an upward trend here. When you're looking at a trending market, we like using moving averages. So here the middle line is the 20-month moving average. Since this is the monthly chart, and we've just chosen the 20-day here. So that just means we take we take 20 days worth of price, we compute its average, and that's the brown dot. It says close, so that means we take the closing price for 20 days and take the average of those. Now, the point I wanted to make here is, if you just look at the 20-day moving average, you can see here most of the time it's above the line. So I mean, if the price is increasing, in general it'll be above the average. Now, when it does close below the 20-day moving average, then it seems to be in a downtrend. So it's normally going up, 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 up. It falls here, but it doesn't manage to break through the 20-day really. It does briefly. So it struggles along the 20-day, then it jumps back up again. But here, where it actually breaks through the 20-day, it then just collapses down. So the basic method here would be, if your price is above the 20-month moving average, then you're in a bull market. You should be long in this case, the DAX. If you're below the 20-day moving average, in general, you should be short, since the trend tends to be down. So that's why you like moving averages when you're talking about trends. So from that perspective, today, the 20-month moving average is down here, the price is up there. So then, if you're above the 20-month moving average, you're in an uptrend. So you want to be long. At the same time, we're a good bit above the 20-day moving average. So, you know, it could easily fall straight back to, all the way down to the 20-day moving average, and you'd still be in an uptrend, kind of. That's what makes trading interesting. So that's just the idea of negative divergence and using moving averages when you're talking about trends. So typically, you know, here I've used a 20-month. If you're doing a daily chart, it might be above the 50-day moving average, the 20-day moving average, and there's always the 200-day moving average, which is an important level. That if you're below the 200-day moving average, that would tend to be a bear market. So the 200-day moving average would play a similar role to the 20-month moving average by the looks of this chart. There are other types of markets. So, you know, the stock market tends to be trending, and it tends to be trending up. The oil market, on the other hand, or you could say many commodities, is kind of different. So we can see here until about 2005, the market's nearly trending. Or the market's nearly range bound. Range bound means that you have a lower bound, so you have a bottom and a top, and the price just bounces around between them. So if you're trading something which is range bound, then when it nears the top, you sell. Put a stop loss just above the top of the range. Then the price will tend to fall back towards the bottom or near the middle. So you trade on that basis. When it's high in that range area, you sell it, since it might hang around up there for a while, but it's unlikely to break higher. And if it breaks, you take a small stop loss, and most likely you'll make money, but as the thing falls. Here, of course, the recent period has been interesting and historic, as oil's broken up, zoomed up. It had zoomed up in the 1970s. I'll see whether this chart goes back that much. No. So it shot up, shot down. Now, looking at this, it seems to be very strongly trending once it broke, because it's essentially in two modes. When it's going up, it just goes up and up and up and up. So if you just see how's it going, well, at the moment the last 2 or 3 bars, the candlesticks have been green. Well, it's just going up and up and up. So you want to be long, you want to buy it. And when it falls, it's just fall. It's very consistent until it hits. So you don't know. It was kind of like yesterday when I was looking at the DAX and I was talking about catching a falling knife. It's the same thing here. You know it's going to hit a bottom, but there's no way to work out what it's going to be. So all you can do is go with it until, like we were talking about with the DAX yesterday, once you see the candles flip, so there's some once the price action is telling you, oh, I think we're flipping, then again go with it. Once you have some green, buy it. So to follow the price action, you can't theoretically calculate what's going to happen. So, okay, in that way, this has both. This was an example of not being like a commodity. I mean, not being like the stock market. It was more like range bound. While once it was 2005, it's become trending. So there isn't anything which is just range bound or just trending. These are the different modes of behavior. So first thing you want to figure out is what I'm looking at trending or range bound? And then your trading strategy then you can choose your trading strategy. Range bound is less risky because you can kind of go, it's jumping around between these two levels, so your losses aren't going to get out of control. You can say that's my stop loss there and a stop loss below the lower range. It's more localized. Range trending, though, is potentially more easy money. So if you hop on and just ride the trend, you can make lots of money very easily. Though, of course, things are never that easy. This is Dailyfx, which is my favorite. It's more for FX, so for currencies, though it also talks about oil and gold, interest rates, various things. So you have experts giving lessons even about what's happening today. You have free trading courses. There's loads of stuff there. So it's just www.dailyfx.com. Yeah, there's tons of stuff there. Finally, I just wanted to look at the inflation calculator, which is worth keeping in mind. So that tells you that if you had $20 in 1987, that would be worth $41 now. So essentially, we've had over 100% inflation in that period. If we go back to the stock market, so 1987, then so this is the German, not the American, and we're talking about American inflation. But so the stock market was roughly 1,500. So if inflation has doubled, that would be 3,000 today. So it's kind of interesting that when the markets really fell, they fell down to what, 2,600 in 2003. So I'll go back to so that's 50% roughly, or 60%. So sorry, what was that? So it's 1,500. 60% would be 800. So that'd be 2,400 in 2003. And it dipped down to 2,200. So after the dot-com bubble, the markets fell below even inflation. It would be one of the figures that you'd be aware of. You know, I mean, when we had the 2007-8 crash and it was falling, you're trying to go, do I buy now? Do I buy now? It's so cheap. Do I buy now? It's very tempting. So, you know, when it started to go up there, had things bottomed? It's the perennial question, and you don't know the answer. But one of the things you would use is inflation. Well, let's go back to, 50 years, and how much of the increase in the stock index is due to inflation. And so if it falls, if you kind of go, okay, this is a big bottom, then you'd go, how much inflation has there been from there to here? When you were trying to predict what this bottom was going to be, that would be one of the ways that you would try and guess, forecast. Another one would be, if you're looking at a company, you work out the book value. So if the company sells everything, sells all the real estate, whatever, is the company worth less than even the book value? I know that happened with Tesco, I think, last year, as markets were really punishing it. And so that would be, for value investors, you'd kind of go, I'll buy that. Book value is my base support. So if you get a company whose value has fallen to book value, and it's a good, you fundamentally believe in the company and the management and all that kind of stuff, that would be a potential trigger value to start buying a bit of. So that's just, again, a sample, a selection of some ideas from trading, which of course is a vast field. Next week we'll look at currency trading, which is quite different in nature to the stock market. Have a good weekend.